Visa just announced they're settling payments in stablecoins, not testing. Settling? That means the money moves instantly, not in 2 days. Most people think this is about crypto. It's not. This is about who controls the plumbing of money itself. By the end of this investigation, you will understand 5 things. First, why payment authorization and settlement are different and why that gap costs you money. Second, how stablecoin rails enable 24/7 instant settlement and what that breaks in the traditional system. Third, why this threatens bank deposits more than any interest rate ever could. Fourth, which institutions win and which face existential risk in a tokenized payment world. And fifth, whether this is innovation or the quiet dismantling of monetary control. This is not financial advice. This is educational analysis of payment system architecture and institutional incentives. Let's begin. When you swipe your card at a coffee shop, 2 things happen, but most people think only one thing happens. You think the money leaves your account immediately? It doesn't. What happens immediately is authorization. The card network checks if you have enough money and puts a hold on it. The merchant sees the approval. You get your coffee. Everyone's happy. But the actual money? That doesn't move yet. Settlement happens later, usually 24 to 48 hours later. The money travels through a complex chain: your bank, the card network, the acquiring bank, and finally the merchant's account. Each step takes time. Each step has a fee. This delay exists because traditional banking operates on batch processing. Banks reconcile accounts at specific times. They don't talk to each other continuously. They settle in waves, usually at the end of the business day. Weekends and holidays. The system sleeps. Money freezes mid-flight. This creates what's called float. Float is the gap between when you authorize payment and when the merchant gets paid. For you, it's invisible. For merchants, it's expensive. They pay for the delay. They pay for the risk. They pay fees that cover the cost of this multi-day, multi-party settlement process. The traditional system was built in the 1970s. It was designed for a world of physical checks and closed banking hours. It works, but it's slow, and slow is expensive. Think about the layers involved. Your bank holds your deposit. When you swipe your card, your bank doesn't immediately send dollars to the merchant's bank. Instead, the card network acts as an intermediary. It tracks who owes whom and settles the net balances at the end of the day through a clearinghouse. This clearinghouse is usually operated by the Federal Reserve or a private consortium. The process involves multiple message formats, reconciliation steps, and risk management procedures. Each layer adds cost and time. For small businesses, this delay creates real pain. Imagine running a restaurant with thin profit margins. You process $5,000 in card payments on Friday night. That money doesn't hit your account until Tuesday. Meanwhile, you have to pay suppliers on Monday. You need a line of credit to bridge the gap. That credit costs money. The float is invisible to customers, but it's a tax on merchants. Now let's talk about what changes when settlement happens on a blockchain using stablecoins. A stablecoin is a digital token that represents $1. It's issued by a company that holds actual dollars in reserve. When you hold a stablecoin, you're holding a claim on those dollars. The token lives on a blockchain, which is a shared ledger that updates instantly and never sleeps. Here's the mechanism. In a scenario where a payment network enables stablecoin settlement, the flow changes completely. You authorize the payment with your card as usual, but instead of waiting 48 hours for traditional settlement, the merchant receives stablecoins within seconds. The tokens move on the blockchain. The merchant can verify receipt immediately. No waiting, no float. This eliminates the middleman layers. The card network still handles authorization and fraud detection. But the settlement rail, the actual movement of value, bypasses the traditional banking correspondent network. The money moves peer-to-peer on a shared ledger. Why does this matter? Because it changes the incentive structure for everyone involved. For merchants, instant settlement means instant liquidity. They don't have to wait for cash. They don't have to pay as much for working capital loans. They can negotiate lower fees because the network's cost structure just dropped. In industries with thin margins, restaurants, retail, gas stations, this is significant. For payment networks, this is a strategic shift. They're acknowledging that settlement infrastructure is being disrupted. By adopting stablecoin rails, they're protecting their authorization and fraud prevention business while outsourcing settlement to a cheaper, faster technology. They're unbundling the payment stack. But here's where it gets interesting. Where do those stablecoins come from? In the traditional system, money sits in your bank account. The bank uses your deposits to make loans. Your money funds the banking system. When you pay with a card, the bank doesn't move physical dollars. It just updates ledgers and settles with other banks later. In a stablecoin system, money gets converted to tokens. Those tokens are backed by reserves held by the stablecoin issuer, not by your bank. If a large payment processor starts settling in stablecoins, merchants receiving payments would accumulate tokens, not bank deposits. Those tokens represent dollars held at the issuer's custodian banks, not at the merchant's local bank. This creates a deposit drain. Banks lose deposits. They lose the raw material they use to make loans. The stablecoin issuers' partner banks gain those deposits instead. This is a concentration risk. Deposits flow away from thousands of community banks toward a handful of large custodians. The mechanism is subtle but powerful. Every stablecoin payment shifts a small amount of money out of the traditional fractional reserve system and into fully reserved token custody. If this scales, it could reduce the money multiplier effect that makes modern banking work. Let's dig deeper into the technical architecture. Traditional card settlement uses messaging standards like ISO 8583. These standards were designed in the 1980s. They're robust but inflexible. Settlement happens in batches because the underlying infrastructure can't handle continuous real-time updates at scale. The clearinghouses that process these batches operate during business hours. International settlements can take even longer due to correspondent banking relationships and foreign exchange conversions. Blockchain settlement is fundamentally different. The ledger is always on. Transactions are atomic. They either complete instantly or fail immediately. There's no batch processing. There's no waiting for the next clearing window. The settlement finality is near instant, limited only by the blockchain's block time, which for many networks is measured in seconds. This architectural difference has downstream effects. In traditional systems, chargebacks and disputes happen after settlement has already occurred. The money has moved. Reversing it requires a separate process. In blockchain systems, smart contracts could potentially enforce dispute resolution logic before settlement completes. A merchant could receive tokens in an escrow-like smart contract that releases funds only after a dispute window passes. This would protect consumers while maintaining instant merchant liquidity. Let's trace the chain reaction layer by layer. At the top, you have the payment networks making a strategic decision. They see blockchain rails as inevitable. They choose to adopt rather than resist. They build stablecoin settlement into their infrastructure. This is not a pilot. This is production-ready plumbing. Next layer down, the merchants. In a scenario, a merchant receiving stablecoin settlement has three options. Option 1, convert the tokens to dollars immediately and deposit them in their bank account. This costs a fee, but keeps them in the traditional system. Option 2, hold the tokens and use them for their own supplier payments if those suppliers also accept stablecoins. This creates a closed-loop economy where tokens circulate without touching banks. Option 3, earn yield on the tokens by depositing them with a crypto-native institution that offers interest. Option 2 and 3 are the disruptive paths. They keep the money outside the banking system. Now consider the small business owner who receives $10,000 per day in credit card payments. Traditionally, that money hits their bank account in 2 days. The bank sees the deposits. The bank offers them a line of credit based on that cash flow. The relationship persists. But if that $10,000 settles in stablecoins and the merchant holds them in a digital wallet for even 24 hours before converting, the bank loses visibility into that cash flow. The bank can't offer credit based on deposits it doesn't see. The merchant's banking relationship weakens. Here's the next layer. Fintech platforms, payment processors, digital wallets, neobanks, they all stand to benefit from stablecoin settlement. They can offer instant payments without needing banking licenses. They can hold user balances in tokenized form and avoid the regulatory overhead of deposit insurance. They become the new middlemen. But there's a catch. These platforms need to convert between stablecoins and bank dollars constantly. That conversion happens at on-ramps and off-ramps, which are regulated entities. If regulators tighten access to those conversion points, the entire system bottlenecks. This brings us to the banking system's response. Banks will not sit idle. In a scenario where deposit outflows accelerate due to stablecoin adoption, banks would raise interest rates on deposits to compete. They'd offer better terms. They'd fight for sticky customers. This creates deposit competition. Deposit competition sounds good for consumers, but it's expensive for banks. Higher deposit costs squeeze their net interest margins. Smaller banks with less capital can't compete. They lose deposits to larger banks with deeper pockets. Consolidation accelerates. Now let's talk about the money market impact. Stablecoin issuers hold reserves in very safe, very liquid assets. They might hold reserves in treasury bills, overnight repos, or bank deposits at systemically important institutions. This creates massive demand for short-term government debt. It also creates a new class of too-big-to-fail entities, the stablecoin issuers themselves. If a stablecoin with $100 billion in circulation faces a redemption run, the issuer has to sell its reserves. That's $100 billion hitting the treasury market or the repo market at once. This creates price impact. It creates volatility. It creates systemic risk. The Federal Reserve is watching this closely. In a regulatory response, the Fed might require stablecoins to hold reserves at the Fed itself, turning them into narrow banks. Or the Fed might issue a central bank digital currency to compete directly with private stablecoins. Or the Fed might restrict which institutions can issue stablecoins and how they can operate. Each regulatory path changes the endgame for this technology. Let's examine the network effects. In the early stages, stablecoin settlement creates a chicken and egg problem. Merchants won't adopt unless customers use it. Customers won't use it unless merchants accept it. But once a critical mass forms, adoption accelerates exponentially. If a major e-commerce platform or ride-sharing service integrates stablecoin settlement, millions of merchants and consumers suddenly have incentive to participate. The network tips. The velocity question is critical. In traditional banking, money velocity is constrained by settlement delays. Your paycheck sits in your account for days before you spend it. That money is lent out by your bank during that window. In instant settlement systems, money velocity could increase dramatically. You receive payment, spend it immediately. The merchant spends it immediately. Money moves faster. This could be inflationary if not matched by productivity increases. There's also a custody question. Who holds the keys to tokenized money? In traditional banking, the bank is the custodian. You trust them. They're regulated. They're insured. In tokenized systems, custody could be self-hosted or outsourced to specialized providers. A merchant receiving stablecoins must decide whether to custody them in a wallet they control or delegate custody to a third party. Each choice has trade-offs between security, convenience, and regulatory treatment. Let's translate this mechanism into everyday impact. For you as a consumer, stablecoin settlement could mean faster refunds. When you return a purchase, the money could come back instantly instead of in 5-7 business days. It could mean lower fees for international transfers. It could mean 24/7 payments that don't care about weekends or holidays. But it also means new risks. If your payment settles in stablecoins and you later dispute the chargeback process becomes more complex. The merchant already has the tokens. Reversing settlement on a blockchain is not automatic like it is in traditional card networks. Consumer protection frameworks built for bank-mediated payments may not apply cleanly. For merchants, instant settlement is transformative. Cash flow improves, but they face a new decision. Do they trust the stablecoin issuer? What happens if the issuer fails? What happens if the token loses its peg to the dollar? These are not theoretical risks. Stablecoins have depegged before in moments of stress. For banks, this is an existential question. If payments flow through stablecoin rails and deposits drain to token custody, banks lose their funding base. They lose their role as the settlement layer for the economy. They become less central to commerce. Some banks will adapt by becoming stablecoin custodians themselves. They'll earn fees holding reserves for issuers. Others will integrate token rails directly into their treasury management products. But banks that resist or move slowly will find themselves disintermediated. For regulators, stablecoin settlement creates a monitoring challenge. Traditional banking is transparent to regulators. Regulators can see flows, they can enforce rules, they can intervene. Blockchain rails are more opaque. Transactions are pseudonymous. Enforcement is harder. This creates pressure to bring stablecoins under stricter oversight. In a policy scenario, regulators might require all stablecoin settlement to flow through registered payment processors who report to authorities. This preserves oversight, but adds friction. It recreates some of the costs that blockchain was supposed to eliminate. The deeper question is about monetary sovereignty. If a significant portion of commercial payments settles outside the banking system, the Federal Reserve's ability to implement monetary policy weakens. Open market operations work by changing bank reserve levels. If money lives in tokenized form outside banks, those tools become less effective. This is not a distant risk. It's a foreseeable consequence of large-scale stablecoin adoption. The payments plumbing is being rewritten, and the rewrite has macroeconomic implications. Consider the tax implications. Traditional payment systems automatically report transaction data to tax authorities. Banks issue 1099 forms. The IRS has visibility. In tokenized systems, reporting becomes more complex. If a merchant receives payments in stablecoins and converts them to dollars periodically, each conversion might be a taxable event. The accounting burden increases. Compliance becomes harder. There's also a financial inclusion dimension. Traditional banking excludes billions of people globally due to high costs and documentation requirements. Stablecoin systems could enable anyone with a smartphone to participate in the global payment network without a bank account. A migrant worker could receive remittances instantly in stablecoins, avoiding wire transfer fees. But this also creates risks. Without bank intermediation, there's no fraud protection, no deposit insurance, no recourse if something goes wrong. The energy question matters too. Different blockchain networks have vastly different energy footprints. Some use proof-of-work consensus, which is energy intensive. Others use proof-of-stake, which is more efficient. If stablecoin settlement scales to billions of transactions per day, the energy consumption of the underlying blockchain becomes a public policy concern. Regulators might favor networks with lower environmental impact. Stablecoin settlement is not about crypto hype. It's about infrastructure replacement. The authorization layer stays with the card networks. The settlement layer moves to blockchain rails. The banks lose deposits. The system fragments. This is the new plumbing reality. Faster payments, lower costs, higher systemic complexity. Watch for 3 signals in the next 6 months. First, Do payment processors announce partnerships with stablecoin issuers at scale? Second, do banks raise deposit rates aggressively to compete? Third, do regulators issue guidance on stablecoin reserve requirements? If all three lights turn green, the transition accelerates. The traditional settlement system becomes optional. The tokenized economy becomes default. Next episode, central bank digital currencies and why the Fed's hesitation might cost them control of the dollar itself. Subscribe to track the payment wars.